Darling, two people can live through the exact same market crash and end up with completely different lives. One panics, sells, and loses 10 years of progress. The other quietly buys more and gets rich. That difference is not luck. It is not intelligence. And it certainly isn't what the financial news tells you. My old banker friend, Arthur, understood something most people only realize when it is far too late. A crash is the only moment the market offers future wealth at a discount, and yet it still manages to make ordinary people run from it in a cold sweat. While amateurs stare at red screens like mourners at a funeral, professionals become strangely calm, not because they enjoy losing money, because they know what comes next. Today, I'm going to show you exactly what Arthur did when the market looked its ugliest, and why the people who use this moment will often build more wealth in a few weeks of fear than others build in decades of optimism. Now, why do intelligent people fail so badly during crashes? Because fear makes expensive decisions feel responsible. The market falls 12%. And suddenly, doing nothing feels reckless. Selling feels mature. Panicking feels strangely productive. People start refreshing their portfolios every 7 minutes like they're waiting for lab results. I once watched a heart surgeon sell everything after a bad week in the markets. A man trusted to hold human hearts in his hands, undone by a simple ETF. You see, darling, your brain is a wonderful organ for avoiding saber-toothed tigers, but it is a catastrophic liability for managing a portfolio. When you see red on a screen, your amygdala, that primitive screaming part of your mind, doesn't see a market fluctuation. It sees a predator. It signals your body to run. This is why intelligent people do such spectacularly stupid things. They aren't investing anymore. They are surviving. But in the market, survival instincts are the fastest way to financial suicide. Your ancestors survived because they ran from danger. Investors become wealthy because they sometimes walk toward it. Nature built your brain to avoid discomfort. Compounding rewards those who can occasionally ignore it. Arthur used to say that wealth is simply the reward for those who can sit on their hands while their pulse is racing. He didn't have better data. He just had better nerves. Here is what Arthur understood before most people ever do. A market crash is terrible if you need to sell. But if you are still buying, it is a luxury sale wearing tragic lipstick. Imagine your favorite designer bag. Last month it was $4,000. Today it is $2,800. Same leather, same stitching, same status symbol people pretend not to care about. Would you scream and run from the boutique, or walk in calmly and ask for 2 colors? But here's the cruel part nobody tells you. A crash punishes 2 people very differently. The person who sells loses money. The person who keeps buying acquires future wealth at wholesale prices. 10 years later, they often look like they invested in different markets. Yet we must be brutally honest about the math, because the numbers don't care about your feelings. If your portfolio drops 50%, you don't need a 50% gain to get back to where you started. You need a 100% gain. You have to double your money just to stand still. This is the asymmetry of loss. It is the gravity of finance. This is why Arthur was so obsessed with buying while others were selling. By lowering his average cost during the panic, he wasn't just buying the dip. He was rewriting the laws of gravity for his own wealth. He understood that a crash is a hole, and it is much easier to climb out of a hole if you're still throwing extra ladders down while you're at the bottom. Arthur never asked, "Why is my account lower today?" He asked, "How many more pieces of the world can I buy this week?" Imagine you invest $1,000 every month into a broad market fund. Last month, shares cost $100. Your $1,000 bought 10 shares. Simple, elegant, civilized. Then the market panics. Headlines begin performing theater. The same fund falls to $50. Your next $1,000 now buys 20 shares. Not 10, 20. You did not become poorer. You became a larger owner. That is the difference amateurs miss while hyperventilating near financial television. If the market later returns to $100, those 20 shares become 2,000. The panic discount doubled your future upside. Same money, more ownership, better outcome. Now let us discuss the wealth feature people ignore because it sounds too dull to mention at brunch: dividends. Many broad market funds pay cash simply because you own them. Small payments, quiet payments. The sort of income loud people never notice until they desperately need some. Imagine your fund pays you $200 in dividends during a crash. If shares cost $100, that buys 2 new shares. But if panic cuts prices to $50, that same dividend buys 4 shares. Double the ownership, no extra effort. Arthur adored this. While nervous people were refreshing the market every 6 minutes in silk pajamas, his money was calmly buying more money. Arthur once called dividends the world's most boring employees. They never complain, they never call in sick, they never ask for a raise. They simply show up every quarter and quietly buy more assets. Frankly, darling, if half the executives in corporate America behaved like dividends, shareholders would sleep much better. I call them dividend ghosts. They keep working while you sleep. They keep compounding while the crowd rehearses catastrophe. Elegant money is rarely noisy. Now let us address one of finance's most expensive fantasies. I'll wait for the bottom. Darling. Nobody rings a bell. There is no handsome man in a navy blazer whispering, "Madam, we have reached the exact low." To put a price tag on your hesitation, look at the numbers. If you had invested $10,000 20 years ago, you'd have a small fortune. But if you had missed just the 10 best days because you were waiting for things to settle down, your final balance would be cut in half. Half your life's work gone, simply because you wanted to feel safe for 2 weeks in October. Safety in the market is a very expensive illusion. Arthur didn't look for safety, he looked for value. He knew that by the time the news says it's safe to buy, the profit has already been made by people who were brave when it was terrifying. He bought on the way down, he bought at the bottom, and he bought on the way back up. Irritatingly profitable. And that reveals something most people never understand. Every major crash creates a transfer of ownership, not from poor people to rich people. That story is too simple. Ownership moves from emotional people to disciplined people. The market does not reward intelligence nearly as much as it rewards behavior. So what did Arthur actually do when markets fell? 3 things, very unfashionable things. First, he kept buying on schedule. Every month. Rain, panic, recession, nonsense. If it was the first Tuesday, the money went in. No debate, no emergency meeting with people who think cash in a drawer is a strategy. Second, he increased contributions. If the market fell 15 or 20%, he added extra cash when possible. Not because he was brave, because discounts deserve attention. Third, he protected his peace. He kept cash reserves for real emergencies, so he never had to sell investments at ugly prices to fix a leaking roof or an expensive divorce. That part is crucial. A crash is only an opportunity if life does not force you to liquidate in the middle of it. Arthur used to say, "The market is chaotic enough, darling. Your household should not be." Arthur became comfortable in bull markets, but he became rich in crashes. Because rallies reward optimism, but crashes reward discipline. And discipline is rarer, more attractive, and far more profitable. The next time markets fall and people begin behaving like Victorian widows, remember this. Prices dropping does not mean wealth is disappearing. It means wealth is changing hands. From the emotional to the patient, from the loud to the prepared, from people chasing headlines to people quietly buying the future. So when the next crash arrives, do try to remain calm. Someone else's panic may be paying for your retirement, and really, darling, it would be rude not to accept.